Welcome back. It's a special broadcast of the latest Monetary Policy Committee decision on interest rates from the Reserve Bank. We've just heard moments ago Reserve Bank Governor Lesetja Kganyago holding interest rates steady. It stands at 6.75%, which means your prime lending rate at banks, 10.25%. Well, two economists to try and dissect exactly what the statement is telling us from the Reserve Bank. From Argon Asset Management, Dr. Thabi Leoka, thanks for coming in. And senior economist at FNB, Mamelo Matikinga. Thanks very much indeed for talking.
It's a pleasure.
All right, so Mamelo, let's start with you. I was saying during the break that just largely speaking, there was an expectation for the governor to cut interest rates. Today, it didn't happen.
Yeah, as you rightly mentioned, expectations was for a cut, but I think there was always recognition that the members might be at odds about the timing of the interest rate cut. And I think the fact that the bank hasn't had enough time to incorporate the latest inflation figures into their model also points to why I think the decision was a bit difficult to make at this particular point. I think the governor emphasized quite a bit in the statement that the risks to the inflation outlook are on the upside. And it would have been interesting to get a sense of what their expectations for the electricity tariffs are for next year, because ultimately that has quite huge implication for the inflation profile for 2018. He did mention that if there is a 20% increase in the tariffs, that could potentially lift the inflation rate by 0.2 or 0.3%. And I think the fact that food prices as well, they haven't actually incorporated that into their model. It would have been quite interesting to see if there is any major changes in the inflation profile. But as it stands, I mean, when I look at our forecast, it does seem as if they're not sure at this particular point in time. I get the feel that the market is expecting a double-digit increase in electricity next year. We certainly have around 10% penciled in right now because we don't have enough information. And that does have a huge implication for the profile later on in 2018. But if we look at inflation, I mean, from October onwards, we're expecting it to be below 5%. And, perhaps, once the SARB gets more information around November, they will be in a better position to make, a decision. Because if it's not November, my feel would be that then they won't move.
It will never come. Thabi, what do you think about the fact that he spent a lot of time talking about the risks to inflation?
Yeah, he talked about the currency risk. He mentioned the risk to the risks associated with ratings downgrade. He talked about the risks of outflows should there be an increase in rates in the US. He talked about also the risk of if we see increases in GDP in Europe and in the US, obviously that makes those countries more attractive, and that could lead to outflows as well. But at the same time, he talked about, inflationary expectations coming down. He talked about, the inflation is still way below the upper limit of the target band. I feel that he should have actually cut rates because this cycle is going to be very shallow, given the risk. And the risks are not short-term risks. The risks are more medium to long-term risks. And in order for us, given especially, I know that growth is not the responsibility or the sole responsibility of the Reserve Bank, but given that we have very little in terms of stimulus, I think that, cutting rates further would actually support economic growth, at least in next year and in 2018. So I felt that they should have taken advantage of this opportunity, cut rates in November, and then wait and see what happens in December before making a move in January.
Yeah, that's a very interesting point. I mean, I think that also went along with expectations, didn't it, Mamelo? This concept of front-loading your interest rate cut, because by his own words, electricity tariffs are going up. Come mid-2018, you're going to see inflation emerge again on the upside. Why do you think he didn't do as Thabi recommended or suggested, cut now because inflation's going to change mid-next year?
I think, as you rightly mentioned, the window of opportunity is very short. I think for the, I would say, economists or analysts that were calling for a cut, there was, as I said, a realization that the members are going to be at odds, that it could be now or it could be in November. And if it's not November, you've missed that boat. By the time we get to the November meeting, they will have, I think, a little bit more information. They'll have more inflation prints. And he also mentions in September they're expecting inflation to tick up because of the petrol price. And then I think they would have had enough time to actually take in all of this information and also have a look at the implications of the medium-term budget policy statement and what that means for the rand and implications for the central bank. As I said, it's either November or they've completely missed the boat. And I think that you know, the risks are quite high, and they've had to deliberate and, you know, just balance that.
Would a rate cut, would a rate cut made a difference to business and the average consumer, even if it was 25 basis points?
Definitely, because cumulatively it would have been 50, and if you expect, because my expectation was actually that they would front load it, and so we'd see 75 basis points this year, that would, you know, be, that would put a lot more sense in consumers' pockets versus not doing anything. I think the risk here is a stop and start, and so they've already cut rates in their previous meeting. I would have expected them to do that now, and now it's this wait and see that, you know, November is also close to the other risk that we haven't mentioned, that they mentioned as political risk. So you don't want a situation, as Mamela said, where actually you've missed the boat completely and you've just only had one rate cut. And the next move will be rate hikes when those risks start becoming real. So you don't want, we know that already that June is a very important month, only because of also a rating agency. We know that also next year is going to be a very important year politically, and it's going to be a lot more noisier than we see now leading up to to December, only because we're leading up to 2019 to the national elections. So you'll have more contestation from all political parties. That's bound to be very noisy. You also have the risks of more increases should inflation reach the US target. We could see more hikes in the US as those economies, US and Europe, as those economies start to strengthen. And those are the risks that we don't want to, that may stifle the possibility of rate cuts. And I think that they really should have cut rates now, and then we would have at least enjoyed the benefits of the rate cut in future in 2018. But having this one cut, and also I think that the excuse of not having put the inflation number in their estimation, in their discussions, in this two-day discussions, is actually a bit disappointing, because we had all forecast the CPI number. We had expected an increase because of the petrol price that was higher, and assuming that because petrol prices are going to be slightly higher because of the currency, you then add that factor in your forecast. So them not doing so is a bit of a strange one to me, and because there's also uncertainty. The uncertainty that we don't have is the electricity price, but that's only next year. So I think the only uncertainty is actually quite far. You knew that petrol prices are increasing. You have that a month in advance. You know that inflation as a result will uptick a bit. You know that food inflation is coming down. You know that meat has been sticky. So I think that nothing is new in terms of what we're seeing in inflation. So I would have expected them to consider those factors and factor them into their forecasting.
What about the rand, Mamela? Let me bring it to you. I mean, he says that's possibly one of the biggest risks to the inflation, and he's mentioned a few things. I mean, the rand being key, he says it's susceptible to political events, and again, there's uncertainty there. There was a question about what the implications would be for a downgrade if you see these capital outflows. What's your take on how he answered that?
I actually didn't catch his response to that question, but I think the rand has been a key risk the whole year, and he's been highlighting in all the statements that we've had this year that this is the biggest upside risk to the inflation outlook. And I think, as he rightfully mentioned, event risk on the political front heading into December and also October is quite high. But I think what we've seen over the past couple of days is that the rand has reacted quite negatively to the rise in inflation in the US and the possibility of a very high possibility of a Fed increase in December. And I think that this is basically going to be what we see throughout next year, because there's 3 rate hikes penciled in by the Fed next year. And also, if we look at the BOE, they're starting to sound quite hawkish in terms of monetary policy. And there is also an increased possibility that, the ECB could increase interest rates next year. So from an international perspective, this time right now would have been great to ease policy because the rand remains quite favorable. But as, time goes by, internationally, internationally the risks are quite high. He also mentioned that the current account has been quite favorable. And if we actually think about it and look at it, terms of trade are expected to peak quite soon, meaning that we're going to see a deterioration in the current account in the quarters ahead. So that support is going to fall off. And then he also mentions credit downgrades. I mean, we've been going on about this for quite some time, that in next year, in June, there's an increased possibility that we could get downgraded. The sovereign ratings are going to give their reviews in November, and we anticipate that they will wait and, get a sense of what the political landscape and the plans are after they get the medium-term budget policy statement and the February budget before they make a decision in June. But as things stand, it does seem as if, that downgrade is also pending.
The implications of this outflow of funds, if our local currency does take a knock into sub-investment grade, Tabi, how significant and you think crucial is that event?
It's very significant. It's more so because if, let's say, if Moody's downgrades us, then we're going to basically leave the index, the Citi WIGB index, and that's what a lot of analysts have been looking at. The amount of flows that will come out, and those flows will be in billions. And it varies, we've seen 50 billion to 100 billion. It depends, it's very difficult, I guess, to estimate the outflows because it depends on also what investors are, the investors' tolerance to a downgrade. So those who will have to leave will do it, but then they also will you could join other indices which, let's say, Citi has. So we could be supported by that in terms of a full-on outflow. Some may like South Africa, and I think we are helped by the fact that our emerging market peers have also been downgraded. So it's a matter of not, I think, weighing up your options. Do you still want to stay in South Africa, or do you want to get out of South Africa and rather go to a Brazil or a Turkey? But I think that we are supported somewhat by the fact that, investors may not want to leave completely. They may want to put their money in other less attractive indices. The problem with South Africa, though, is that it's an election year. So there's a lot of risk that will threaten investors, which in a year that will be loud, noisy. And I think that is negative for investors and negative for South Africa.
Okay, I'm afraid we're running out of time. I'm going to have to leave it there, but thank you very much, ladies, for joining us. From Argon Asset Management, Dr. Tabi Leoka, and Senior Economist at FNB, Mamelo Matinga. I'm told we've got an ad break, so we can still check out the growth aspect of all of this. Okay. To a break now. When we come back, more analysis. Welcome back. We're still with that analysis of the latest interest rate decision by the Reserve Bank. The Reserve Bank governor announcing just moments ago that interest rates remain steady. The repo rate at 6.75%, which means that your prime lending rate at banks remains at 10.25%. With me from Argon Asset Management, Tabi Leoka, and Senior Economist at FNB, Mamelo Matinga. Thanks very much indeed. We've got one more section. Let's start by looking at the growth prospects that the Reserve Bank tells us. Basically, it remains the same, Mamelo, just up, I think, 0.1 percentage point from 0.5% to 0.6. Of what significance is this?
Not much. I think there was a lot of excitement and hype, around the second quarter GDP release. We did see that the economy expanded by 2.5% quarter on quarter. And this is because the base of the first quarter was really horrible. But if we look at the sustainability of that momentum going forward, it is quite clear that if we look at the latest data that we have, particularly retail sales have been released, manufacturing, mining, that has been quite weak, suggesting that the third quarter should report quite weak growth. And if we look at business confidence, which the governor also touched on, we did see that that index jumped by 6 basis points to 35, but that's still well below 50, suggesting that businesses are not feeling very optimistic about the current environment. And we're seeing that in the investment numbers that came through in that GDP release, that actually fixed investment activity continues to contract. In fact, the private sector, pulled back even more in the second quarter, and that number was actually helped by government activity. So I think that the data that we have is consistent with an economy that's growing at below 1%. His numbers are more or less in line with ours. As I said, because there's no impetus for economic growth, it's very difficult to see the economy growing above 1%.
Which is why, Tabi, I mean, again, to your point, this period could be used as an opportunity to actually help that growth number, shouldn't it? But it never happened.
Definitely. I mean, I think the period should have been used to stimulate growth, and it hasn't. They haven't, and we're going to struggle. And I do think that the percentage point increase is really very little. I don't think they should have actually increased it. I think that I agree with Mamelo. The third quarter is going to be quite weak. If you look at high frequency data, it points to a much weaker economy. And this reason why we had this increase in the second quarter is mainly because of base effects. And certain sectors rebounded also in the second quarter. But we are unlikely to see that in the third quarter. And also it's going to be very difficult in the fourth quarter. I think that we need to think beyond just percentage points increases. 2.5% is really weak. If you look at the World Bank came out with their estimates, and they revised down our GDP from 1.1% to 0.6%. So we're basically hovering at half a percentage point GDP, and we should really be growing at least 3%. Actually, and above 5% if we were to bring down the very high unemployment rate of 27.7%. So again, we're really just bumping at the bottom. We're still flirting with recession, and anything that could just pull us down, whether it's a slowdown or an unexpected slowdown in mining or manufacturing, that could lead us back into below zero growth.
And Mamelo, do we rely at times a bit too much on the Reserve Bank for boosting growth in the country? I mean, essentially we have a structural problem. But nevertheless, I think that you still have those analysts and many people that look to the Reserve Bank for that impetus. But do we rely too much for growth on the Reserve Bank? I
think the reliance on the Reserve Bank over the past couple of years has increased. But it's quite important for us to continue to communicate that that's not their mandate. Of course, a cut in the interest rate would have provided some relief to the consumers, especially your highly indebted consumers. It would have helped in terms of restoring their balance sheets. But I think, as you rightfully mentioned, that to stimulate economic activity, we need to look elsewhere. We need to really address the structural issues that we have. We really need to address this depressed business confidence that we're seeing to ensure that the economy gains momentum.
And that business confidence, Tabi, I think 33-year lows. Again, the governor not afraid to mention the fact that political events are still bringing that down. Do we have to wait until this big elective conference in December to see that change?
I'm afraid it's not even just December. I'm afraid that we have to wait till after 2019. We almost have to start afresh in terms of policy, because we're going to adopt a new policy, or the ANC is going to adopt a new policy in December, but we don't know whether that policy will be the country's policy in 2019. So that is a big uncertainty. Talking about business confidence, also even consumer confidence, it's going to be very difficult to increase consumer confidence and business confidence at a time when there is a lot of political noise and political uncertainty. And it is unlikely, I don't expect business to invest massively in South Africa when there is this political uncertainty and the noise that we are going to see and get from now till 2019 elections. And again, this will also slow growth. If we don't expect investment to increase, where else are we going to get growth from? I think that the three sectors or areas where we should see growth, or at least a combination, is from the Reserve Bank through stimulating, and that we've already concluded that if they don't front load it, then they won't have an opportunity to hike rates in the latter part of next year. Fiscal policy is supposed to be stimulatory, But again, in an environment where we are cutting the spending ceiling and we have huge shortfalls on the revenue side, that is unlikely to happen. And actually, I fear that we could see increases in taxes as a result, which then does the opposite. It stifles growth. And we also should see business. Business is also a very significant stimulant to the economy. And if investment is not there, we are unlikely to see increases in investment.
Coming off that, Mamela, how important will the midterm budget next month be to business confidence? What are you looking for?
I think, let's keep in mind that the MTBPS is an update of the targets that were set in Feb. So they're just going to tell us where we are relative to what we had anticipated. So as it stands, we have received indication that, the government is going to miss some of their revenue targets. And if one looks at the numbers that we have to date, it does suggest that that shortfall could be around 44 billion. So what will be interesting is to see if they provide us information as to how they plan to plug that shortfall. It could come now or it could come next year. But as Tabi mentioned, it does seem as if there's a real possibility that taxes could go up. The governor also touched on that in the MPC today. So there's a real possibility that we could see tax increases that might also stymie economic growth. The minister did give us his 14-point plan, and he said, there'll be further detail in the MTBPS. So it will be quite interesting to see, how they plan to actually stimulate economic growth, if there's any detail in that MTBPS. I would say the big thing to really look out for would be the February budget, and I think the sovereign rating agencies as well will wait to see what the government's plan is come next year. And
justifiably so, Tabi, because the governor says himself that internationally, I think these were his words, the environment is relatively favorable. I mean, if you look at Europe, you look at Japan as well, all speaking to the fact that the struggle really is domestic, isn't it?
Definitely. And here's a problem with an increasing, well, at least an improvement in growth elsewhere, is that leads to outflows. So this is the period where we should be capitalizing on our inflows, capitalizing on the fact that inflation is low, capitalizing on the fact that despite the political noise, we're actually plodding along. We're not in recession. We've just come out of the recession, and I don't think enough is done now. And unfortunately, if we find ourselves in a very difficult position in the quarters ahead, it will be very difficult to come out of it, given that we have fiscal limitations, we have monetary limitations, we're going into a political year. So I just think that this is the time, this is our opportunity to actually capitalize on the inflows and the low inflation. And low inflation we didn't because we didn't cut rates, and we'll see what happens at the NTBPS and what color in terms of or hints that they would have, because even though they don't give detail on taxes, we will get an idea, given that we are currently below the targets or not at target. So it just will be interesting what they say, and it will just also give us a picture of what to expect in future.
I've got a few seconds left, Mamela, so I'm going to end with you. Just judging from what you spoke to me about a few seconds ago, do you suspect that we've seen it? That's it. We're not getting cuts in the near term for now.
The fact that the governor this time around didn't emphasize if we are still in this cutting cycle is a bit of a cause for concern for me, because it does suggest that actually they're not committing to anything right now. They will wait and see.
I'm going to have to leave it there, ladies. Thanks very much indeed. That's where we ended. From Argon Asset Management, Tabi Lyoka, and Senior Economist at FNB, Mamela Matinga. Thanks very much indeed for talking to us. All right, that's where we leave it. More details on the story in our later bulletins.